Today we will be analyzing the S&P 500 index. In recent days, the outlook for the index remains cautiously positive, but I wouldn't call it outright bullish. On the one hand, the S&P 500 is holding the area around 7,500 points. On Thursday, it rose by just over 1%. During the same period, the Nasdaq gained 1.9%. On Friday, there was a slight decline, but nevertheless, the week closed with a green candle. The main driver of the market remains the artificial intelligence sector. According to analysts' estimates, the profits of technology companies could grow by about 39% this year and account for more than half of the total profit growth among companies in the S&P 500 index. In addition, the largest IT companies continue to actively invest in AI infrastructure. According to Goldman Sachs estimates, spending on such projects could reach $754 billion as early as this year. In other words, money continues to pour in. Analysts at the largest Wall Street investment banks are also very optimistic. For example, Goldman Sachs has raised its target for the S&P 500 to 8,000 points by the end of this year. Morgan Stanley is even more bullish, 8,300 points, though by the middle of next year. At the same time, Morgan Stanley is projecting earnings growth for the index's companies of about 23% this year and another 12% next year. Wells Fargo has also raised its forecast. It raised its target for the index from 7,300 points to 7,950. The index is currently trading around 7,500. Overall expectations for earnings growth remain strong. Moreover, these expectations at the level of 23 to 24% outpace revenue growth forecasts, which are about plus 12% year over year. But even such a result could be the best revenue growth rate since 2022. And at first glance, this is quite a strong bullish argument. But every bit of optimism has its downside. You've probably heard of the PE ratio. That is, this is a ratio that shows the relationship between the stock price, the market price, and the earnings per share. So if you buy a share for $500 and the earnings per share are $10, then essentially the purchase price is covered by 50 years of earnings. That is a lot. So, according to Goldman Sachs estimates, the S&P 500 is currently trading at about 21 years worth of earnings. This is higher than where the market has been in about 88% of cases over the past 40 years. So there is growth potential, but the margin of safety is no longer that large and the risks are increasing. Secondly, investor positioning is becoming quite heated. According to Bank of America's June survey, large funds still have a strong bias toward long positions. This overweight amounts to about 38 percentage points. This is the excess of longs over shorts. In May, it was even higher, about 50 percentage points. So optimism has decreased, but funds are still heavily invested in the stock market. At the same time, the share of cash held by investment funds is about 4.1%. This is a very low liquidity reserve in case the situation starts to deteriorate. There is no sign of panic among retail investors either. According to the latest data, about 37% of market participants are bullish, 24% are neutral, and 39% remain bearish. On the one hand, this doesn't look like euphoria, there are more bears, but on the other hand, there is no strong sense of fear either. At the same time, 39% bears is certainly a lot, and it cannot be ruled out that the market may continue to rise for some time, forcing some of the bears to close their shorts and join the buyers. The next risk is the concentration of growth. A few of the largest technology companies are having an increasing influence on the index. Well, we all know them: SpaceX, OpenAI, Anthropic. And above all, these are companies connected to artificial intelligence. As long as the AI sector is growing, everything is fine, but if investors become disappointed with the growth rate, a correction could be quick and quite sharp. There is another important risk: inflation and interest rates. The Federal Reserve closely monitors the core inflation index. It is one of the key indicators of inflationary pressure for the American regulator. If inflation starts to accelerate again toward 3.4%, there are such estimates, then talk of rate cuts could very quickly turn into talk of rate hikes. And let me remind you that high interest rates mean more expensive money, which in turn increases the risk of an economic slowdown, slower profit growth, and greater pressure on the stock market. If we draw an overall conclusion about the S&P 500, the sentiment is quite bullish. The AI boom, massive investments in artificial intelligence infrastructure, target upgrades from investment banks like Goldman Sachs, Morgan Stanley, and Wells Fargo, as well as the index holding above key medium-term moving averages. But the market is already expensive. It is trading near historical highs. The market's dependence on a handful of AI companies is increasing, and it's hard to call these companies truly profitable. You may not know this, but OpenAI is a deeply unprofitable company, while SpaceX and Anthropic are more or less breaking even. That's why it's important now to look not only at the potential for further growth, but also at whether the index is holding key support levels after such a rapid rise. Now let's move on to the technical analysis of the chart. As usual, we won't be analyzing the index itself, but rather the ETF fund shares that are linked to it, multiply by 10 to get the approximate value of the index, so 746 times 10 is 7,460. And if we switch to S&P 500 index futures and mini futures, we'll see that they closed the week at 7,556 points. Well, it's about the same. The only difference is that the index itself showed growth on Thursday, while the ETF fund shares with the ticker SPY actually declined on Thursday. But overall, the profile is the same, the chart profile. Notice that we already had a divergence formed on the daily candles. Here are two red segments, one on the RSI indicator and one on the price. And I assume that considering we saw a relatively strong rebound from about the 50-day moving average, we could move to new all-time highs and form an even stronger divergence. Yes, it won't be a pure divergence. Why? Because on the RSI we went below the 50 mark. But nevertheless, it still indicates that this growth is running out of steam. People are no longer willing to invest as much money into it as they were before. And this suggests that risks are increasing. Next, if we look closely, the index is currently trading above all the moving averages. I mentioned this in the introduction. But at the same time, the last movement we saw here is a bearish engulfing of the growth. Even if we temporarily switch to futures, we'll see the same thing happened here. Two red candles engulfed the green growth candle, while the green candle, however, did not engulf the red candle of the decline. That is, according to formal indicators on the daily candles, the index has turned downward. However, all of this is happening within the range that was established for us roughly in mid-May. Next, let's go back to the ETF fund or to the ETF fund's shares and switch to weekly candles. On the weekly candles, we remove all the markings and we see that the week before last closed in red. It closed with a bearish engulfing pattern. This indicates the risk of further decline, and until there is a reversal engulfing of this red candle from June 1st, we can't talk about a continued rise. Let's also take a look at the futures and mini here. You see that on the weekly candles here, the situation is exactly the same. Yes, there seemed to be growth over the last 2 weeks. Both weeks were green, but this candle, which by formal criteria reversed the trend downward, has not been engulfed. And if next week we see a new all-time high, but the close is below the opening point of the candle from June 1st or May 31st, whichever you prefer, since futures and stocks can trade differently, then in this case we have a chance to see a full-fledged divergence on the weekly candles with a strong decline into which area? Well, the target level for the decline will obviously be the base of the candle from April 26th. Why? Because we've already gone down to the base of the previous green candle. That was 7,330 points, and the next level is 7,235 points. But if this decline continues, we could end up somewhere in the region of 7,000 or 7,100 points. Let's return to the ETF fund shares, because here the chart is continuous and long, whereas futures have a trading start date and an expiration date, so their chart is fragmented and quite limited in terms of time period. So what do we see here? We see that we have the 50-week moving average around the area of approximately 6,800 points. I automatically multiply by 10. So if what I just mentioned happens, that is, if there is a new high but the close is below the level of this week, which absorbed the growth, then there is every chance not only to go down to the 50-week moving average, where we already were at the end of March, but also to the 100-week moving average, which is already around 6,300 points. Let's look at the monthly candles. Yes, and note that the RSI is in the overbought zone and has started to move down. Monthly candles. On the monthly candles, the situation can't exactly be called short, but a lot will depend on how we close the June candle. If after updating the all-time high it closes in red, then that's already a red flag for buying. Moreover, notice that here the highs are clearly rising, but here the corresponding highs on the RSI are clearly not rising. This is a divergence, and it's clearly pronounced on the monthly candles, and it indicates that the decline may not only reach the 50-month moving average around 5,350 points or 5,500 points, but could go significantly lower. Note that we've already dropped to the 100-month moving average before. So, if this situation develops, we could even see the 200-month moving average, because the market is definitely overheated. Let's return to the daily candles and identify the key levels. On the daily candles, I've marked the key levels as I see them, and now I will speak specifically about the ETF fund stock to avoid confusion, because on Thursday there was a drop here, while on Thursday the actual index was rising. And to avoid mixing up the charts, we'll talk specifically about the ETF fund's stock. Look, there was a key reversal level at $748.17. On Thursday, it was broken through. On Friday, despite the rebound, we couldn't hold above it, which means that this entire short structure with bearish engulfing suggests a decline towards the level of $731.58, and potentially even lower to this level, which was set not so long ago on June 10th at $725.33. Ultimately, this is the area of the 50-day moving average. At the same time, if on Monday we see a consolidation above this level of 748.17, then our chances of moving, first of all, to the next level of 759.45 increase sharply, and secondly, to updating the all-time high with the formation of a divergence. And the fact that 39% of retail investors remain in short positions suggests that the market or the index could make another upward move in order to squeeze out these 39% of short sellers. Not all of them, but at least some, and to give hope to many others who might want to buy at historical highs. I, on the other hand, recommend that you refrain from any purchases. Despite the fact that the index seems to keep rising, and despite the fact that the largest investment banks are forecasting the index to grow to around 8,500 points by the end of this year and even into the middle of next year. I hope you heard me. You shouldn't buy at historical highs. It's better to buy at significant, say, yearly or even multi-year lows. So have patience. I also hope you hear my other message. The Quant Fury platform, where we did our analysis, allows you to trade thousands of financial instruments with absolutely zero commissions, from the stock market to the cryptocurrency market, from forex to commodities, indices, ETFs, and much more. Goodbye.